The holiday shopping season is shaping up to be a good one this year. That's according to fresh insights from Mastercard spending polls, which found that Black Friday retail sales were up 3.4% from last year. Online retail sales were up by 14.6%, while in-store sales inched up by less than 1% from a year ago. And joining us right now with more on the findings and the rest of the shopping season is Meyer. She is chief economist at Mastercard Economics Institute. Michelle, let's just start with those Black Friday numbers. That's pretty strong numbers, up by that much. How much of it is because the holiday season is later, and how much of it is we're just dealing with a stronger consumer?
So I think it's a little bit of both. The calendar effect certainly means that consumers have been monitoring, they've been watching what's available and gearing up what seems to be to spend on this one day on Black Friday. And I think it's a search for value as well, which is contributing to that. And that's a theme that we've seen from this consumer for some time. Once we started to see this relief on inflation, starting to see prices decline and promotions come back in, consumers have been really geared to find those deals and that best value. So I think that's another big motivating factor that drove considerably strong spending on e-commerce on Black Friday. I
mean, that says something, though, too. If they were waiting for deals and the sales number was still up, even with those deals,
yes,
that means they're buying a heck of a lot more stuff.
100%. You have to think about the volume, right? Because this is nominal spending. So within that is real sales or volume. And it does certainly seem like that was quite strong because it's an environment where promotions were pretty heavy.
So what does that actually tell you about the strength of the consumer? If they're spending, but only when a deal comes, what does that mean?
Well, I think the consumer has the ability to spend, they have the willingness to spend, but they're being savvy. They're being really mindful about trying to make sure that their purchasing power is used in a way that is most powerful for them. But they have the ability to spend because of the labor market. Right, and we're going to see what happens on Friday. It's going to be quite important in terms of understanding how the labor market is continuing to evolve into this holiday season. But as of now, jobs are still being added at a pretty solid rate. The unemployment rate is hovering still at 4.1%. And wage growth is running above underlying price inflation. So there's real wage growth and real purchasing power. And those are really important factors for consumers, especially this time of year where they're that much more willing to go out and engage.
How are you feeling about the economy overall when you look at what corporations are doing right now? I mean, you can look at the stock market, and we've been watching it since the election. It's really last month was the best month we've seen when it comes to the markets. How does that translate into what you see in the real economy?
Well, I think the fundamentals of the economy are sound, and they have been throughout this cycle. People have been underestimating this business cycle, underestimating the economy, and I think that's been a problem, right? Because we've seen time and again an economy that's running above its underlying trend, partly supported by the consumer, but also supported by businesses. Business investment has been strong. The last few quarters have shown that improvement. R&D is driving it, but we're also seeing some improvement in CapEx as well. And the supply side of the economy has been another force that I think has been a positive that people also have probably underestimated. The fact that the labor force participation rate for cyclical workers, that's picked up. Productivity has been strong. So it's this combination of stronger demand side responses and supply side positive dynamics that have led this economy to continue.
There's no way the 10-year should be going down in yield right now, given everything that is being proposed in terms of, adding to the deficit, tariffs, more tax cuts, all these things. So other than the economy telegraphing some weakness, there's nothing else that explains why we're at 421 on the 10-year right now.
But think about how it's bounced around over the last several weeks.
Why'd it go up? Why'd it go up after the Fed cut twice? They cut 50, and then why did the rates continue to go higher, higher?
It was a bit of a repricing of monetary policy in the Federal Reserve. So when you saw that first Fed cut and the summer dovish sentiment around the Federal Reserve kicked in, it was a view that the Fed was just going to be continuing to cut. The economy was more feeble. The data since that first 50 basis point cut looked better. Growth looked better. Jobs looked better. Retail spend looked better.
Okay, so yields went up. So then why are they coming down then?
I would argue that it's not a trend lower, that it's kind of just hovering around. I don't think it's meaningful. I think
we heard 375 that we could hit from Shriek.
I think it's pricing in and out policy, both monetary policy and fiscal policy.
Look, and it did come down ever since the Scott Bessent was signaled as Treasury Secretary, and you wonder if that's going to be a signal of what to really expect with tariffs. Who knows?
He's a tariff guy, though. He's on board with that.
So he says now.
Yeah. tariffs might not necessarily, we don't know how many.
It depends on how they're used.
And it depends on if they're used.
Implemented.
I guess.
Yeah. Or if they're used as just a negotiating tool.
But everything we're hearing, rates should be headed higher. And that was a big fear that, oh my God, if Trump gets in, the rates are going to go through the roof. So I don't understand.
I don't think it would matter. I mean, we're going to be spending increases.
Yeah, but combined with tariffs and all the tax cuts.
Yeah.
I think it depends on whether you're pricing in policy, you're pricing in fundamentals today, right? Because the 10-year is supposed to be how the economy is faring into the future. So that's where I do think a lot of the gyration is coming from how the market is pricing in future policy, both monetary and fiscal policy. To your point, Becky, around thinking about cabinet appointments and how policy is going to translate, whether or not it's inflationary over the long run or not.